Get Rich Education is brought to you by Ridge Lending Group, the Real Asset Investor, and Corporate Direct. Cash flow real estate investors, this is Get Rich Education's Keith Weinhold. Did you know that you can finance up to 35 income properties all with one lender? Ridge Lending Group specializes in investment property loans, and they do it in almost every U.S. state. Ridge has worked with tens of thousands of real estate investors and homeowners all over the country. They've been doing this for investors for so long that at this point, they've helped more families realize their dreams of becoming real estate investors than any other mortgage lender in the country. To find out more, visit ridgelendinggroup.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, welcome to Get Rich Education. This is episode 111. I'm your host, Keith Weinhold, back for another wealth building week. I hope that you've been living abundantly. Are you having a hard time finding a good passive buy and hold real estate investment deal? Well, we've got an alternative today. That is to let someone else find the deal for you, and you can participate right alongside them, and you can still get a nice return. Next week, I'm going to take to the microphone all by myself to talk about how your 401k plan is just destroying your dreams. And we're even going to have a little piece on the 401k's history and just how it came to destroy dreams and lead to retirements that end up being delayed and completely underwhelming, or both. That's next week for another one of my slack-jawed monologues. Now, I have one investor friend out there that's just been crushing it for years with larger apartment buildings. That's what we're talking about today. And he lives in Lancaster County, Pennsylvania. Yes, home of my Grandma Weinhold, a place I visit every year. And he owned a number of successful businesses before starting in real estate investing, most notably his pre-built modular construction business. Of all his entrepreneurial accomplishments, he even authored a book in the For Dummies series. You know those ubiquitous yellow For Dummies books? He authored Building Chicken Coops for Dummies. That's really not the business he's most known for, but it's just one of his more, I guess, esoteric accomplishments. Today, he's going to tell us how he transitioned from the business world into a full-time real estate investor several years ago. And because you've got to invest where the numbers make sense, he specializes in the apartment building niche in Memphis, Tennessee, a market that you're familiar with. So not my friend's home market of Lancaster County, Pennsylvania, but Memphis, Tennessee. And I think you already know that Memphis has not just the nation's, but the world's busiest cargo airport, with the FedEx hub being located there. It kind of runs neck and neck with Hong Kong for the number one ranking as the world's busiest. Well, that makes for a stable tenant base that stays put because those jobs are rooted right there. They can't be offshored. In fact, Memphis has all 4 R's of infrastructure in great measure: road, river, rail, and runway. When you consider Memphis's truck traffic, Memphis is actually in the top 4 nationally in each one of those 4 modes of transportation. They've got a low cost of living, and of course, for real estate investors, it's traditional strength with those high rents in proportion to low real estate prices. You're going to meet my investor friend, and before we're done, he's going to give you some numbers about the percent rates of return that he's been providing for his investors. Today's guest has been a successful investor and entrepreneur for most of his adult life. With real estate holdings in many states and nations, he specializes in the multifamily apartment space in Memphis, Tennessee, and in resort development investment in Belize. Since 2009, he's bought over $60 million worth of real estate, really making him one of the most successful real estate syndicators in the nation, with over 2,300 multifamily apartments in his portfolio. He's a published author and guest speaker. He, his wife Susan, and his 4 children live in Lancaster County, Pennsylvania. Welcome to Get Rich Education, Dave Zook.
Hi, Keith. Thanks for having me on.
Yeah, it feels overdue to have you here. So, Dave, tell us a little bit about your background and then how you got into real estate.
Yeah, so my dad bought a modular building business back the year I was born. And so I grew up in the business really all my life. And as I was growing up in the business, I saw my dad also investing in real estate. And he was self-managing some of his real estate and he really did quite well with it. But I saw some of the headaches that he was going through and I just decided, you know what, that's not going to be me. And I sort of went in another direction. I knew I wanted to be an investor, but knew I didn't want to be a real estate investor. So as I was growing up and I was trying to figure out who I was and what I was going to do, in my late teens, I started investing in businesses. I invested in a business or two of my own. And after a number of years, they started really doing well. So back then, I really didn't have a tax plan. And I was just out there doing my thing and running my businesses and making a lot of money. And I was also told that if I make a lot of money, I get to pay a lot of tax. And I really believed that. Well, I started paying a lot of tax, hundreds of thousands of dollars a year. Fast forward that a couple years after really educating myself and getting around the right folks, I realized that theory wasn't necessarily true. And I realized with the right strategy, I could make a lot of money and pay very little tax. I soon realized after getting around those right people that investing in real estate using the right tax strategy could be a very effective way to protect myself and be able to keep the money that I was making instead of giving almost half of it back to the government. By the way, those people I started getting around are regular contributors of your podcast. Guys like Robert Kiyosaki, Tom Wheelwright, Robert and Russ from the Real Estate Guys radio show, and a bunch of others. So getting into the multifamily real estate checked a lot of boxes for me, from cash flow to appreciation and amortization. But the big one for me and the one I needed the most was depreciation.
Yeah, when one grows up in a real estate family, often it seems like that parent did self-manage. And when you grow up in that and in your formative years, you kind of feel that struggle and that friction when your father, if he's doing his own renovation and he's his own managing. And it doesn't seem like a very desirable thing to do. But you kind of entered real estate from a higher level. You got connected with the right people originally because you wanted to learn about tax mitigation from your other businesses. And like they say, you are the average of the 5 people that you spend the most time with. So you got around the rich dad people. Talk about some more of those influences and how that helped you.
Probably many of your listeners, that little purple book, Rich Dad, Poor Dad. I mean, that was definitely a starting point for me. And, that led me down that path. And when you seek, you will find. And I was hungry and I was searching and really searching for not only the right content, but the right people to get around and people that I knew that could help me or people that I knew were where I wanted to get to. So meeting up with Tom Wheelwright, he said some things to me that really stuck with me. And one of those things was, if you want to change your tax, you got to change your facts. That stuck with me. It was like, wow, if I start behaving a different way, I'll start getting taxed differently. And of course, I was having all kinds of fun. I was, running a couple different businesses that were doing really well. I was a hard money lender and just doing all kinds of things, thinking that I could make a lot of money, but I didn't have a tax strategy. And when I really got smart about where I focused my energy and resources and started investing smarter, that's when my tax situation changed. And it was all about getting around the right people and Tom Wheelwright and his folks and the guys over at Provision. And it was definitely a learning process, but it was well worth it.
You've become such a respected person in the real estate investing community, I think, because you really lead with helping with others. And you're also a respected person in your own local community there. And you kind of told me about an epiphany that you had when you served on the board of a local bank, just with how everyday people understand investing.
Yeah, so after I started investing in multifamily for a while on my own, I got invited to sit at the table with a group of guys who wanted to start a small local community bank. I knew most of the guys around the table, just a great group of guys, but I picked up a few comments like, well, we might not see any kind of ROI for 5 to 7 years, but it's better than putting our money into a CD. I couldn't believe what I was hearing. These guys were successful business owners, most of them able to stroke checks in the 7 figures, and they were making investment decisions based on the return on a CD. So it was soon after that I went to see one of the guys who's now the chairman of the board of that bank. He's a good friend of mine, and he's also a CPA. And I showed him what I was doing in the multifamily space, and I asked him what he thought about the idea of taking what I was doing and inviting local businessmen or folks who had some success to invest alongside of me in my deals. Back then, syndication was a pretty new concept for me, and I didn't even know how to spell it. But that is sort of what spurred me to action and started syndicating real estate projects.
So syndication, we're talking about pooling and aggregating other investors' money into a deal that you've gone and identified. And yeah, isn't it remarkable, Dave? Even people, serving on the board of a startup bank, just not understanding basic investing concepts like the importance of cash flow or how much is your rate of return beating inflation, not just what is your rate of return. It's pretty remarkable. So this kind of planted the seed for you to become a syndicator.
Yeah, and the interesting thing to me is there's very successful business people that have put all their time, effort, and resources into their business and have managed to run that business for 20 years, and now they're sitting on a pile of cash. It's interesting to me how educated they are in running that business and how successful they became, but from a financial education and how the tax system works and how money works and all that, they're normally somewhat uneducated.
Yeah, I often say people spend all this time learning about how a business works. They don't spend any time learning about how money works, but yet money is what keeps them in business.
That's correct.
So you had the seeds planted to go ahead and help other people by pooling their money together and giving them a return with a deal that you identified. How did that begin? How did you go about doing that?
Well, it was pretty simple. I was buying real estate. I was buying multifamily deals and did a few of them on my own until I simply ran out of cash. And okay, do I slow down and just do less deals and do them all on my own? Or do I use the team that I had set up, the broker that I had set up, the number one broker in Memphis? Do I use that team, leverage that team, and help other people get in the same kind of deals that I was doing? And, those guys that were sitting in the bank, and those guys that have successful businesses and are sitting on a pile of cash, not knowing what to reinvest that cash into, I just thought, you know what? If there's a way I can help them and that we can also move forward, because you run the risk of, if you slow down and you stop doing a lot of deals, you run the risk of not getting that first phone call when there's a hot deal going on, or there's a deal that needs to close in the next 30 days. You run the risk of that broker going to somebody else on his favorite call list. So I had a choice to make. I could either slow down and do it myself, or I could maintain the level of activity and bring other people right alongside of me.
Now, you've learned how to operate the right way and get the respect of a lot of people and get good returns for your investors for years. I guess, what are some of the lessons you learned before you started syndicating yourself and you were involved in other people's syndications? What were some of those lessons that you learned that you had to avoid?
Yeah, so the number one most important question for me when I'm getting into a deal is, who are my partners? Who are the players involved? Who am I doing business with? It's a more important question to me than the actual asset itself. I got involved early. It was the first big multifamily deal that I'd done. It was a 72 unit. And, I got in the deal with the wrong person. And I got excited about the deal. It looked good, and it probably would have been good if it was, if the right person was managing the deal. But I got involved, and I got excited. I was the only investor in this syndication.
Huh.
It ended up just the guy didn't perform, but what he said he was going to be able to perform, and it was a mess. It turned out, it was a painful process, and I ended up losing a lot of money over it.
It's people, process, and product, and in that order. It all starts with people. How do you think you figure out? How can you tell now who is real and who isn't real in syndication?
For me, I very seldom invest in somebody who I don't know personally or comes from a very strong third-party endorsement. If you cold call me and tell me about some deal you got going on, the chances of me getting into that deal with you is like slim to none. So for the most part, I would say strong third-party endorsement from people that I like and trust, and or somebody who I know personally. So, I'm going to be looking for stuff like track record. I'm going to be looking, okay, so what have you done the last 10 years? how have your deals turned out? What have you done in a time when deal went bad? How did you handle it? I would rather invest with someone who's had a few bumps and they turn around and work through that process than somebody who's had, nothing but home runs. I want somebody who's been through the mill and come out the other side and they're stronger and better for it.
Yeah, that just gives such an aura of genuineness when someone can go talk about their problems and how they dealt with it. It's kind of like the typical employer-employee relationship in a classic job interview when the boss goes ahead and asks the interviewee, hey, go ahead and talk about a problem that you've had or what's your greatest weakness. And they say something like, oh, my greatest weakness is that I just work too hard. It's like, oh, no, come on, give me something here. Give me a legitimate problem and how you deal with it. Tell me a story about something. Well, you settled on multifamily. Why multifamily and why Memphis?
Well, multifamily for me just checked a lot of boxes. I mean, I talked a little bit about the depreciation part, and it's kind of funny when I hear the Democrats or Hillary Clinton beating up on Trump for not paying his taxes. Well, you know what? It's the exact same strategy that we use. I mean, and it's a strategy that's really available to anybody. So the big piece of that was depreciation and how I needed protection. But it really came down to a few different things. Appreciation was one of them. If you buy in a really good area in the path of progress, you can experience some real appreciation. Amortization, I like the idea of me being anywhere in the world that I want to be in, and there's some guy in Memphis or somebody living in my apartment building that's going to work every day and giving me a portion of his paycheck. So there's a lot of things that really appealed to me in the multifamily space, but depreciation was a big piece of it. But, it's funny how over the years, how when I got my tax situation under control, then that was no longer now number one. Now maybe it was cash flow next. After you get a really good cash flow stream built up, then maybe appreciation jumps up to the number one spot. So it's, it can do a lot of things for an investor, but as an investor, you got to figure out what makes the most sense for you in the situation that you're in right now.
Dave goes ahead and pulls other investors' money for multifamily investment in Memphis. You might think of Memphis as a cash flowing market, but not so much an appreciation market. When we come back after the break, Dave is going to tell us how he forces appreciation on his properties in Memphis. You're listening to Get Rich Education. Our guest is Dave Zook. More when we come back. I'm your host, Keith Weinhold. As a lot of investors know, multifamily real estate has been one of the best asset classes to be invested in most of the last decade. While the great deals have been harder to find lately, there are still opportunities in select markets where savvy investors can get lots of appreciation and strong cash flow if you have a great team. Dave Zook, founder and president of The Real Asset Investor, and his team have been very active in the multifamily space in Memphis, Tennessee. On the heels of the Great Recession of 2009, Dave and his team quietly started acquiring multifamily assets, and in the last few years, he has syndicated over 2,000 apartment units, creating strong cash flow streams and big appreciation for lots of their investors. It's not too late to get involved. If you're an accredited investor and you would like to learn more about investing in great multifamily apartments with a world-class team, email Dave and his team at info@therealassetinvestor.com.
You've worked hard to acquire real estate. Don't lose it in a blue instant. We live in a litigious society. Assets must be protected. Rich Dad advisor Garrett Sutton founded Corporate Direct to provide strong and effective asset protection for all investors in America. Corporate Direct offers personalized attention to your specific situation and is very affordable. Call 800-600-1760 and mention Get Rich Education for a $100 discount on all formations. Garrett Sutton wrote Loopholes of Real Estate, Start Your Own Corporation, and Toxic Client, among other bestsellers. He and his experienced team at Corporate Direct want you to be protected right now and with proper corporate maintenance into the future. Visit corporatedirect.com today for a free incorporation kit or call 800-600-1760 for your Get Rich discount. That's corporatedirect.com at 800-600-1760.
This is our Rich Dad, Poor Dad author, Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. And the reason I respect Keith, he's a very strong, smart, bright young man.
Welcome back to Get Rich Education with our guest, the real asset investor, Dave Zook. Dave, you force appreciation on multifamily apartment buildings in Memphis. Tell us about how you do that.
I live in a farming community, and I look at it a little bit like farming. You buy the asset, you nurture it, you boost the performance, and then you reap the reward. You reap the harvest. The difference here is that your harvest comes every quarter. We like to buy properties that need some help. They may be 80 to 85% occupied. Maybe they were bought before the downturn in '08. They were owned by an out-of-town investor group. That's always a good indicator for us, or a sign of opportunity for us. And they need some good, strong local management. We like to buy in the path of progress. I talked about my team and how important that is to me. You know, when you have a really good broker who belongs to the real estate clubs and he belongs to the Chamber of Commerce, he knows what's coming down the pike. That's just super value.
You're talking about your broker in Memphis here.
Yeah, so when you have someone like that on your team that's just really immersed in the market and knows what's coming down the pike, that's so valuable. Let's say we know that in the next 12 to 24 months, the city's getting ready to spend a lot of money on infrastructure or improvements in a certain area. We like to buy in that area before that happens. With a good team who's consistently looking at those things, you can get in at a good price and experience some real appreciation.
Okay, so how does that resonate through to an investor then?
The way we structure our deals on the cash flow and the equity side, we get paid when the investor gets paid. So we get cash flow when the investor gets cash flow. And when we get that property performing really well, we all win. And so it's the same on the equity side. When we can get into an area that's up and coming, and we can get into that property that's 80 to 85% occupied, and we can get that occupancy up to 90, 95%, and get that NOI up, that's where the real value happens. And that's when you get all kinds of options, not only on a possible sale in 5 to 7 to 10 years, but what about a refi? And, you just got all kinds of options at that point. We can take that value up from 2 or 3 million to 4 or 5 million, and now you can refinance, you can, sell in 1031. We're very conscious of the tax law. So when we do sell, we want to be looking at what do we do with the money? How can we forward that and get into properties that really give us even more potential going forward?
Okay, so let's say that there's an investor with some money that calls you up and she or he says that they're looking for a deal. What would you tell them?
Well, it's an interesting question because early on, I would have tried to fit that investor into a deal that I currently have open. But what I've learned over the years, it's not about me. So let's say I have a cash flow deal, a really good cash flow deal in Memphis, and an investor calls me and asks me what he should do with, $100,000. The first thing that jumps to my mind is, well, I got this deal that you can invest in. Well, that's not how I do it anymore. I like to find out what's important to the investor. I want to know about what the investor's expectations are. Let's say I have that strong cash flow property with limited appreciation, and that investor comes to me with $100,000 and said, I'm going to invest in a deal, but he wants appreciation. And I stick him in the deal that has a strong cash flow with very little appreciation. You're going to end up with an unhappy investor who's not getting his expectations met. So I want to know about the investor and what his expectations are before we talk about any deal that I have over or in the pipeline.
Don't lead with your need, lead with what the investor's need is.
Right on.
Now, one interesting thing that you do with your buildings when you're going ahead and adding value to the buildings, and talk about that a little bit. How do you add value to the buildings? Is that something that you do with the investor's money in order to give them a better return and pool it for economies of scale that an individual investor could not get otherwise? Tell us more about that value add.
Okay, so I'll give you an example of a deal that we did just recently. We went in, we had bank financing on the front side. We had 75% of the bank's money. We come in with 25% of investors' cash. And then we also raised an extra $400,000 or $500,000 for renovations and repair, rehab. And where we do best is when we go into a building that's, doesn't need just a ton of work, doesn't need new walls put up, but it just really needs some heavy touch-up, where we might need to replace soffit and fascia, where we might need, some exterior work in the parking lot, some paint, new carpet and paint the interiors, maybe some new fixtures. And that's where we really do well, is where we can get into something that doesn't need a total rehab, but where you can really go in and just give it a kind of a fresh look and feel, and then move in with good, strong management, show the tenants that we're serious and that we care about them. And then we also do something that's somewhat different from most apartment investors. We install a very expensive, very high-tech surveillance system. We call it our asset management system. And what it does, it allows us to watch every door on the property. We spend $150,000 to $200,000 right up front when we buy the asset, and we can watch the property. And it's just amazing how people behave differently when they know they're being watched. The system's got visual, it's got audio. You can talk to the tenants. You can get an alert when the door opens up, so the tenant's home. It helps with rent collection. And the amazing thing, it also helps with tenant retention. The good tenants don't seem to mind being watched at all.
Right.
They like that their cars are safe, and even more important, that their kids are safe. Neighboring properties know that you're under 24/7 surveillance, and it's just really helped us tighten up our properties that we own and just really manage them a lot better. And really, when that happens, that flows right back to the investor, because when you can get that property performing better, and when you can cut down on crime and vandalism, it just really helps to make that property perform, and that performance flows right back to the investors in the form of increased cash flow.
Okay, well, what about some of the investor advantages? When an investor invests directly, I like to say that they benefit from real estate's returns 5 ways at the same time. Number 1 is appreciation. Number 2 is cash flow. Number 3 is they benefit from the loan pay down. Number 4, they get great tax benefits. And then fifthly, there's an inflation hedging benefit. So really, for an investor that wants to go ahead and invest in someone else's syndication, I guess, what are some of those investor advantages over direct investing?
There are several things, and I'll list a couple of them that just come to mind. Number 1, we go in and set up the financing, and we also guarantee the debt. So my partner and I, we guarantee the debt. So we're giving the investor the advantage of using leverage, but you don't have the risk of guaranteeing the debt. You don't have to guarantee the debt. So you got the advantage, but you got a floor. You got a floor protection.
Okay, and not guaranteeing the debt, meaning that investor, they don't have to qualify for a loan on their own. They don't have to have their credit score checked. They don't have another loan that's going to show up for their qualification and getting future property and so on.
That's correct. They are a passive investor, and my partner Gary and I guarantee the debt. We set up the loan, so the investor is not responsible to guarantee that debt.
Talk about some other advantages over direct investing.
So number 2 would be there's never been a capital call. You have those things that come up, a major repair, a big AC unit, a tree falls down in an apartment, but we've never had a capital call. And one of the reasons is we've always been able to, if we didn't have a full repair budget, we've come out of pocket already short term to cover that until our repair budget got built up. So we never had a capital call. The other advantage would be to, instead of coming out of pocket for all of the 25% down payment of a single property, you can spread the risk. And let's say you could go into 5 different properties with $100,000 for each property. It helps you diversify and kind of spread the risk. The other thing would be just knowing that you have a great team around you that knows how to make that property perform, and a team that's got a really good, strong track record in that local market.
And you have a vested interest in your investment performing for your investors because you have skin in the game yourself. How much skin in the game do you usually put in one of your deals alongside your investors?
Normally it's in the 6 figures on every deal. It's not always the same just simply because of the capital that's available at any given moment. Let's say we close an apartment building and 2-3 months later we close another one. But it's normally into the 6 figures. And I tell my investors that. I let them know that. I said the decisions that we make on this property, on this deal, are not going to be only because I'm looking out for them, even though I am. I'm looking out for myself because there's deals where I'm the biggest investor in the deal. And that's the way I like it, because if a deal isn't good enough for me, it's certainly not good enough for my investors. And I want them to have the confidence that my cash is right there alongside theirs.
Is there a typical percentage range you usually put in, like 5 to 10%?
There's not, because I've had to pull some of my own funds out of a deal already because of investor demand. So there's been times when I wanted to go deeper. I want to put more capital in the deal, and I've had to back up just to let another investor in the deal. So it really depends on cash I have available, investor demand, and there's really not a percentage. It's more related to those two things.
Now, you touched on a little bit earlier that investors are paid quarterly from your deals. What type of return on investment can your investor expect, and then how does the reporting look?
We've consistently been in the 8 to 11% cash-on-cash return. That's what our investors can expect. Normally, if we can't get that, we pass on the deal. In the future, that may change as cap rates continue to get squeezed, but we've found the better we're known in the marketplace and the better we know the market, the better our chances are of being able to secure a deal like that. So I would say in the 8 to 11% cash-on-cash return. And then on the reporting, there is a newsletter that I write every couple weeks to the investors, keep them up to date. There's 6-month profit and loss and balance sheets get sent out to each investor. And then obviously there's K1s soon after year end that keep them well informed of what's going on with the property and what the numbers are looking like.
Okay, so 8 to 11% return on a cash-on-cash return basis. What about on an internal rate of return basis when we add in all those other ways that real estate investors are paid? What does the investor in your deal end up getting as a rate of return on that basis?
Generally in the high teens to the high 20s.
Yeah, that's fantastic for completely hands-off. And, I always find it kind of interesting, Dave. One thing that it seems like prospective investors ask about, one question they want to know about, even more so than the returns, which doesn't make a whole lot of sense to me, even more than risk, which doesn't make a lot of sense to me, is what does the K1 look like at the end of the year? What does this mean for their taxes?
So the depreciation gets passed right along to each investor. And what we've done with all of our properties is we get a cost segregation study done so that basically it's saying is you're accelerating your depreciation. So where the typical depreciation is 27 and a half years on an apartment building, when we do that cost segregation study, it moves most of your depreciation up into the first 5 to 7 years of the deal. So it's really helped us to really front load a lot of that depreciation and get the investor the greatest impact in the shortest amount of time that we can.
Yeah, and Dave and I are both clients of Provision, Tom Wheelwright's firm, so you can go ahead and leverage Tom Wheelwright's firm as well through Dave Zook, and you have those economies of scale to apply the cost segregation and accelerate your depreciation, where in your own portfolio, you just might not have the economies of scale to do that.
I learned a lot from those guys. Provision has taught me a lot in the way of taxes and depreciation and how to keep the money that I'm earning instead of giving half of it back to the government. So I owe those guys a big thank you.
So, Dave, as we wind down, any final thoughts on kind of the architecture of your multifamily apartment building deal and how investors can leverage your economies of scale?
Yeah, so we've got some deals in the pipeline, and we expect a busy first quarter. And, if you're accredited and would like to know more or even do some homework ahead of time, just send an email to info@therealassetinvestor.com, and we'd be happy to send you out an executive summary on a prior deal, maybe a deal that we've just done to kind of get you familiar with what we do and how we do it and all that. And then just get on our list, and we'll certainly be able to email out an executive summary on a new deal that's coming up here in the future.
Dave, one cool thing you do is that you have a barbecue that you host at your home annually for your investors.
I am just extremely blessed in that, 5 years ago I had 0 investors and now we've got about 70 or 75. And those investors, some of them were friends before we got involved in the syndication business. In fact, a lot of those guys were friends and, business associates and kind of people that I knew in the community. But I've also picked up quite a few friends and people that I did not know before I got into the syndication business. So it's been really fun for me to get to know new people, and I like people. I like doing deals. I like people. So this is just a lot of fun for me. And to be able to have them to my house once a year in the summertime and do a big barbecue and get everybody together. Some of the most fun I ever have is when I'm around investors, entrepreneurs, and business owners. If you just get around and talk to those folks and visit with those folks, you can't help but get nugget bombed by just, bits of wisdom, and I just love it. So, yeah, once a year we get together at my house and we have a big old barbecue and we just have a lot of fun.
Yeah, I'm sure they're all friends if you're providing them with an annual 20% internal rate of return. So, Dave, besides our listeners sending an email for more information to info@therealassetinvestor.com, is there any other way our listeners can connect with you?
Yes, they can go to therealassetinvestor.com/GRE, where I'll have 2 special reports that cover the Memphis and the Belize markets. And also, if your listeners are interested in going on a field trip with us, they can register to win a field trip in one of those 2 markets.
Okay, that's fantastic. A free field trip right there. Check out therealassetinvestor.com/GRE for those reports and maybe win a field trip to either Memphis or Belize. Your choice. Dave Zook, thanks so much for coming on to Get Rich Education.
Thanks for having me, Keith. This was fun.
Well, you know that I'm a big advocate of direct real estate investing in something like your own turnkey property, or maybe if you're starting out, something like an owner-occupied duplex or triplex or fourplex, but I know that just does not fit everyone's situation. You probably don't want to invest in something like a REIT, either a real estate investment trust, which is basically a Wall Street product, something that's packaged and securitized such that your return is so watered down. So really then, who might investing in a syndication alongside Dave be suitable for? Well, probably someone that expects a better return than what Wall Street provides, someone that has a lump of investable cash that they can afford to tie up for a few years. You need to be an accredited investor. Maybe also if you cannot get a real estate loan yourself, or you're just maxed out on the number of loans that you can get at the best terms, maybe you just want to own a piece of a, say, 150-unit apartment building, but you cannot afford to buy the entire thing yourself. So you still want to get in the game and have fractional ownership. And, consider too, if you wanted to accelerate your tax write-offs with the cost segregation, but you couldn't do it because you usually need to get great scale to offset the cost of having the cost seg engineer come out and do the entire segregation study. Well, here's an opportunity to leverage others' economies of scale and get just a piece of that benefit yourself. This also could be good for investors who reside outside the United States, foreigners. You're effectively already participating in other people's syndications. Maybe you just haven't thought of it that way. For example, when you buy a ticket to fly from New York to San Francisco, you're paying for a shared experience that Delta Airlines put together for you. Okay, you couldn't afford a big jet yourself, and you're willing to pay for the benefit of having a shared experience that you otherwise couldn't participate in at all. So that's a syndication or aggregation of investor capital, if you will, all put together for that transcontinental flight. 2 to 3 years ago, I really had a decision to make in my life. Okay, I was kind of at a Y in the road, and I needed to decide whether I wanted to be a real estate investing educator or a real estate syndicator, aggregating other people's money like Dave. And of course, you know that I chose to become an educator with GRE here. But you know what? Had I chosen to become a syndicator, I would have taken on much of the same structure that the real asset investor Dave Zook has in place now, because we're in the same circles and alongside mentors and syndicators like the real estate guys Russell Gray and Rich Side Advisor Ken McElroy, both of whom I've had on the show here a few times. So had I become a syndicator, I'd likely resemble Dave's model. We also use the same attorney and have the same tax strategist in Tom Wheelwright and more. So I've appreciated your time this week. The best thing for you to do right now is that you might as well go to therealassetinvestor.com/GRE and register for your chance to win a free tour of the real estate market of your choice alongside the real asset investor Dave Zook. Very cool that he's doing that for you. You can choose that free tour in either Memphis, Tennessee or beautiful Belize. Doing that also puts you in Dave's deal flow so that when he has an attractive offering, he'll put it in front of you and you can dig into it and ask all the questions about it that you like. That's all at therealassetinvestor.com/GRE. And don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.